Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention. It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome back to the channel. Today we are going to be talking about liquidity, and we're going to be talking about how we could bring that together with market profile, because I know that I've done a lot of sessions on candlestick liquidity because I really wanted you guys to understand how it actually works. But I'm going to bring it all back to market profile so we can see how we can make it work even with a market profile chart. So there's no reason to panic when you see a time price opportunity chart, or what we call TPO, right? Perfectly normal. So I'm going to show you how to do this. Now, for those of you who are new to the channel, we cover everything here: market profile, liquidity. We basically show you how you can trade the markets and invest like a professional. That's the whole idea about this, is that there's just so much stuff out there, so many gurus out there telling you what to do, but on this channel you're going to get the real deal. That is basically the premise of it, right? So once again, support the channel so other people know that we're here. Other people like you looking for this kind of education for free can tune onto the channel and see what it is that we do here. Right, so moving on. So first things first, I'm going to essentially walk you through the steps, so everything that you need to know to be able to pull off the single best trading strategy out there. It's just how the markets are traded, and I'm going to explain to you exactly why I say that and why you should be looking at that. And if you're not looking at that, it would explain a lot of the challenges that you face as you come into these markets today. And I'm going to talk you through this step by step. Now, granted, I have done a ton of videos. In fact, this is a follow-on video of another video I did around this same topic, but following the market from a couple of days ago. I think it's important when we do these sessions we have a lot of continuity, because again, as you tune in, you're going to find that some people are going to join me and that I've spoken about this before and they have no clue, and you know, they're just like super concerned. But in any case, keep following the channel. Yeah, you can go back and watch some of my videos and you'll see how we do things. So no need to panic, no need to be concerned that, oh crap, I don't know what I'm doing, this seems too complicated. Trust me, it isn't complicated, and this stuff will make your life so much easier. Alright, so let's cut to the chase. So here I've got a charter cable, right? So this is a TPO charter cable. So first and foremost, for those of you guys who are unfamiliar with market profile, and I know it's not very common in the retail trading space, however, it is very common in the institutional trading space, and that's just how things are. Don't ask me why, okay? I have my theories, but again, don't ask me why. So what are we looking at? So here we're looking at a daily profile of British pound sterling, right? Now, the time frames are independent from the chart. We had to code this stuff for MT4, so it works independently, which is why we have a panel to regulate everything that goes on with the TPO chart. The only thing that this specific chart uses is the scale. And I'm going to show you why it is so easy for me to be able to decide what I want to do and be able to put that information out there and have people come back to me and say, God damn, how did you know that? And I just get to say, well, it's just because I like to look at profiles. You're basically getting the same thing that you see on a candlestick chart, but you're just getting it in a more organized fashion, right? So these are profiles, right? So essentially they are, think of them as daily candlesticks, right? So you're looking on here, you're looking at daily candlesticks, and then what the profile does that nothing else can do, it actually shows you what goes on in those candlesticks based on an auction period. That could be 5 minutes, 15 minutes, an hour, 30 minutes, based on an auction period that you can actually select. So what do I mean by that? So I'm going to expand out these profiles. I'm going to split them so you can see the auctions. So here you can see, and we can zoom in a little bit. I tend not to do that because I want to see the whole screen, but you can actually see R period, Q period, P period. And I know if you're using a mobile phone, you're probably squinting at this point in time, but don't worry. When I edit out this video, I'm going to try and get as much zoom effect in anything that I'm trying to show you. So you can see the rotations, right? Quite clear. A, B, C, D, E, F, and they're labeled in letters, and they just recycle back to small letters A, B, C, D, and so on. So this is the auction periods, and all of these together make up one day, right? So we start at midnight, and then we cycle through to current market hours, which is 4 p.m. London time, or GMT. So you can see that here quite clearly. Right, so now that we can see that, let's just zoom back out a bit so you can see what I'm trying to say. And I'm going to split another day, right? So you can see how the days link. There's not too much gapping because we deal in currencies, so I'm going to split another day. So I've split 1, 2, 3, 4, and I've split 5 days for argument's sake. So pretty much I've got a 5-day profile split. So I'm able to see a couple of things. The first thing I'm able to see is the value high and the value low. So that is determined by this little bar here. If we close, oops, didn't mean to do that. It's going to struggle at this stage because I'm not supposed to. There we go. Volume. That's it. So I'm not supposed to split put on the volume chart when I split the profiles. That normally causes the system to seize up a little bit. It's a lot of data being churned through MT4. It's not really designed for this, but we've got it as smooth as we can get it. Now, bear in mind, there are market profile charts, for example, on Sierra charts, in my opinion, just cost more money. So if you can build something like this is awesome. And then you can just use a platform like MT4, MT5, that's pretty much you can get for free on a demo, and then you can benefit from the feed, and you're pretty much saying the same thing. So it's a really good way if you're a new trader to keep costs down. Of course, if you want to go and pay for Sierra charts and you want to pay on a monthly basis, and then you can get a more customizable TPO chart. And in fact, I have a video on this channel that shows you exactly how to set up your Sierra charts time price opportunity. So again, just scroll through the channel and you'll be able to see it. It should be my Trader Knowledge Bank playlist. Anyway, moving on. So you can clearly see here that I've got, so there we go, split this up a little bit. So I've split 1, 2, 3, 4, 5 days. You can see the value high and the value low, right? It tells you the price. You can see the initial balance, right? And what does this mean? Well, the initial balance tells you, it gives you a reading for the first hour of trading. The value high and low tells you what traders have considered value. The low is rather the reasonable or the fair value cheapest prices. And we can also see what the fair value highest prices are. So that's evident. And then we can see the auctions, how each auction fared on. So we can see that. And then we can see what happened over subsequent days. And then we can see other data like single prints, for example. So we know where the market is heavy, where it took in responsive buying or responsive selling, as the case may be. So for those of you who've been following me for the past couple of years, you probably know all about this stuff. But let's pretend that you don't. Now, how do we equate that to liquidity trading, which is why I'm sure a lot of you are watching this channel, because a lot of people are finally understanding that liquidity is something that you can find in specific places on the chart, right? And most people tend to get trapped in these areas, right? And you're going to see why. So let's take a look. Let's expand this out a little bit. So we can see this, and if you look at this against a candlestick chart, so this is cable, as a candlestick chart. I'm just going to put it on, where are we? There we go. Just put it on a 1 hour time frame, and you're pretty much going to see the same thing as we were just looking at there. So you can see almost exactly the same pattern. If I zoom into this, well, let's open it up. Right, so you can see if I then now do this, right, same pattern. You go up on a spike, blah, 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 blah. And then if you look at it here on a candlestick, da, da, da. And that's because these rotations are 1 hour rotations. These rotations or candlesticks are 1 hour candlesticks. It's pretty easy, right? So we can kind of get that. But what information is missing straight away? Well, let's pop here. First and foremost, we don't have everything condensed into the daily profile. So we can't see the value high or low. There is no statistical calculation that's been done to tell you that. So technically speaking, you don't know where fair value is against the chart. You don't know what the initial balance is. So some traders might call this, or might equate this to a kind of opening range. So you can't really see that. And definitely you could see prints, but you can't see them dynamically. So if you're trading, you can't actually really visualize what is a reliable print, right? So there's some things, information you can't get. So if you think of candlesticks as a summary of what's going on, and if you think of a market profile chart as a more in-depth statistical analysis of everything that's going over these frameworks, using the profile as the frame of reference. So this is what we expect to see when we look at a profile chart, and this is what we expect to see when we look at a candlestick chart. However, it's not much difference, to be fair, which is why I can do the same thing on a profile that I can do on a candlestick. Now, the thing the profile chart does for me, right, if you look at this very closely, you can see that you're not getting a lot of anxiety from looking at the profile chart. Even though the price is ticking lower, for example, you're not feeling like you need to do anything. Now let's change that coin picture again. Now you look at this chart. Now all the colors and the way it's illustrated the movement of the ticker all sort of puts you in that position where you feel like you need to act. Either you're going to get scared or you're going to get worried. So it stimulates some anxiety. And that's because a lot of the market has been gamified. They need people to act on impulse and emotion. So the people creating these markets, that is exactly what they're hoping to stimulate. They want to stimulate emotion. Now what we're trying to do is we are trying to remove the emotion from the equation, right? And when we remove the emotion from the equation, we can make logical decisions, right? So that's part and parcel of trading. Now if I click on this here, you will clearly see that the same thing is happening, but we're not getting the same emotional response with the candlestick. And that's because with TPOs, it's kind of a filtered, it's like a point and figure chart. So anyone's seen a point and figure chart, it's kind of the same, it's filtered. So if we trade back up, there is no change in the visual representation of the auction. So in other words, the auction has been printed out, it's been recorded, the price is traded, but we are not getting that same feedback. If the price goes up, nothing changes on the visual, right? So it's not gamified, right? So you can't put up a TPO chart and play it as a game. And this is why people watching this video, a lot of people are not going to be interested, and this is why so few people are in it, because it's not gamified. If you open a chart like this, your intention, and your singular intention, is to make money. You're not going to be interested in gamifying. You probably have a high level of discipline to be using charts like this anyway, because you don't miss the dopamine rush that you get from looking at a candlestick chart. And you guys know what I'm talking about. So you know, let's not kid about, right? So you know that there's this huge dopamine hit, like the gambler's rush that you get when you're looking at a candlestick. Look at that, right? It's insane.
Really serious, insane, illegal shit.
Right? So if you're looking at this and trying to trade, I can imagine you sitting back, watching a chart like this, especially if you're not used to it, and then it does something like that and you go, oh my God, should I get short now? Or should I, you know, you're not really thinking about the logical side. Why am I getting short? Where's the liquidity? There's not enough thinking time. So what you're doing is just reacting to what you see. And some of the gurus out there are going to be telling you stuff like trade what you see. There's even a book called Trade What You See, right? So there's this emphasis on look and trade, and it's just as easy as that. Well, in reality, what they want to get you doing is looking at charts like this, and I kid you not, you try and take their advice, the look and trade advice, and see how that goes for you, because no one can actually do it. Because what's happening here is that they're playing with your brain, your psyche. And as long as they're doing that, you're always going to be making poor decisions, right? Because you're not thinking about the logic of your execution. That's why we use TPO charts. Anyway, enough of that. So let's press on. So we can now put in place, so this is the next step. So the next step is we can now start talking about how we trade this liquidity. So let's take today, for example. We were talking about this the other day. So the first thing I'm going to do, which is almost always the first thing you would do, is try to identify, okay, where the stop's going to be, right? And we spoke about that in the last video. This is a great place, right? So we know that there's stops above R, T, and E period, right? And they're all liquidity that hasn't been visited. So we know there's liquidity here for sure. And what kind of stops are going to be up here? They're going to be buy stops, right? So their buy stop losses and buy stops are going to sit here as orders. So the moment the price goes there, those buy stops are going to get triggered. And I tell you what, who do you think is going to be buying these highs? Retail investors. No institution is buying these highs. But in order for you to get a fill, someone needs to sell to you. And that means some institution needs to take the other side of your trade. So they're going to be selling to you, and they have the advantage. That is why traders lose money a lot. Is because the market, one, forces you to put stops in these levels, because again, if you were short here, your stop's going to be here, right? And you're going to trail that stop to every high, which means that at every high, there's going to be more and more liquidity, right? Because that's just how retail investors are taught, and that's how they think, is that, you know, I've got to trail the stop down. And then when we get back to these levels, people want to execute on breaks. So the even more inexperienced investors are going to want to execute into long positions as we take out new highs, because the information velocity on social media when we approach these highs is almost always extreme, right? And I don't even need to show you proof at this point. Just do it yourself. Whenever the market is at a new high, right, or any asset, it doesn't matter, it could be Coinbase, Bitcoin, whatever. Whenever it's at a new high, just go and have a look at how much information velocity is going about when the market is traded a new high. And then look at where that market was coming from, and then think about, if you can, go on Google, go get out some, you know, newspaper articles, clippings, whatever you can find, right? And have a look and see what they were saying at the time that you would have thought you should be buying, right? So to give you a rough example, take Bitcoin. Now everywhere you turn is Bitcoin, Bitcoin, Bitcoin everywhere. However, when Bitcoin was about 15K, just have a look at what the articles were saying, right? So imagine Bitcoin is now like close enough to like 45K, right? So if Bitcoin's 45K and someone bought it at 15K and you're buying at 45K, well, then just do the maths. You're already in a losing position. Even if Bitcoin goes higher, your pricing hasn't been efficient. So one, you're not going to make as much money. Two, you're likely to stay in the trade longer than you should, with the anticipation that you're going to make as much money as the guy who bought at 15K, but that's not possible. Right?
Fuck you, Peck. You're a Mormon. Ozzy. Next to you, we all have a drinking problem.
So it's all these things, right, that contribute to extreme market losses, a lot of anxiety. So I've kind of labeled a few things that are affecting you. The charts you look at, the way you think about the market, the velocity of information when the market is spooling much higher prices, right? All of this stuff, right? All of this stuff is what's affecting your trading, right? And if you don't believe me, just open your trading account, look at it yourself. Look at the points where you made a mistake. Look where you bought, why you lost money. It becomes very evident, very apparent to you very quickly. And when you did make money, where did you buy, right? And then now you've got to start organizing that data into an execution model, which is the next step we're going to go to. So let's talk about an execution model. So now that we know stops are here, we know they're going to be stops here, and so on. Right, so we saw the market trade down, and I remember saying to you guys that you don't want to be buying the market here. You also don't want to be shorting it here, right? This is no man's land. This is basically fair value, right? The market's in total agreement. There's no inefficiency. No one is extremely wrong or extremely right, right? Because the market tends to move when someone is in an extreme short position or they're in an extreme long position, right? So I did a video on the commitment of traders report, which helps you understand how extreme people can get from an institutional standpoint. And that's even why the market whips around so aggressively at certain levels. We'll talk a lot more about this stuff, but let's focus on the execution model. So here we hit a low S period, which was about 4 p.m. UK time yesterday. So just before the FTSE closed, we bounced off. And what are we going to do? So at that point, we want to put a line. I hate MT4. Sorry, guys. I got to make all these visualization adjustments just to use this thing properly. Right, so it's so archaic, but it, suits the purpose. So here we go. So this is so again, talking about liquidity. Right? So we know there's liquidity here. So the market starts to auction lower in the European session. So this is 6 a.m. London. Now let's be fair. I mean, what trader is going to be trying to trade at 6 o'clock in the morning? Are you making your coffee, or you're just rolling out of bed, or whatever else you're doing in bed at 6 o'clock in the morning, right? You're definitely, I can assure you, definitely not. This really gets to me when you see the gurus and they're like, oh, I get up at like 4 in the morning and I mix my coffee and I watch the charts and I take a breath in and I do my yoga. That's the dream they're selling you. No one does that shit, I can assure you.
The lie detector test determined
That was a lie.
Nobody does that. What you are going to see happen is that people are going to come into the market when they know there's going to be liquidity. When is there liquidity? Well, liquidity tends to show up roughly about sort of 7 a.m., 8 a.m. London time or GMT, right? So that's when you're going to see traders active. Now, what am I looking for, right? So 6 a.m., we've had a early push for liquidity, and then we've closed up in J period. So if we just zoom in on that, right? So you can see we closed up here. This little dot here is close. Started 9 a.m. So we opened, closed, right? That's it. So we closed up here. Now immediately, like we've always said, we've taken out the liquidity, we've shown a strong response, and then we closed on J period. That's 126.96, so just under the 127 handle. That's your long position. Right? Simple as that. Now, risk, well, you can put your stop losses just under the liquidity low. If you want to be really brave, you want to put it under here, right? Now, what have you just done? When you act in this manner, maybe you put your stop loss here. You've done what I said everyone does, right? Is they put a stop in. So that's liquidity. You've just added liquidity to the market, right? When you put a market order here and you went long, you took liquidity from the market. When you put a stop loss in here, you added liquidity, because now anyone who wants to take out your order to the market to sell can bid the prices lower. And this is where they get you, is because algorithms bid the prices lower. It's nothing to do with demand and supply. They just bid the prices lower to catch out whatever liquidity that someone is asking for. So if there's a big buyer looking to grab a lot of liquidity at 26.84, then the algorithm will bid the market lower on the behest of its master to get that liquidity, because it's needed. Someone is offering big for it, right? So you sell to the market at the bid price, So whoever's sitting on that bid is going to be able to buy, right? And that's what's going on. So if you put a sell stop loss here, it will protect you from, of course, not losing more than you would like to, but it also added liquidity that someone else can take in order to get into the market at a favorable price.
You made me swallow my gum.
So there's always going to be liquidity added to the market. In fact, it is encouraged for people to put liquidity into the market by putting limit orders and stop orders. All of these are orders into what we would call a central order book of some kind somewhere, right? Whether that central order book is an algorithm, whether that central order book is in the futures market, or it's in stock, it's an order book. Someone has recorded your liquidity in this market, and that's all that's happened. So you've taken liquidity from the market by executing into the trade, and you've added liquidity here, right? If you'd put a buy stop order here to execute yourself into this trade, then you added liquidity by putting that buy stop order in there, right? Because when you bought, you incentivized someone to sell to you, right? You did that by adding liquidity. That's what we call when we say we're trading the ladder or you're trading order flow. That's all it is. That's all you're doing, is you're either adding liquidity or you're taking liquidity out of the market, and that's all it is. So you're long here, right? And now you think, well, based on the true range, and this is not a model, right? So when you're doing this stuff, it's not all one size fits all. You know that in any given day, this asset can more than likely will at least be able to trade the prior day's value area, because that is where 70% of the price distribution occurred, right? Within that value. And if 70% of the price distribution occurred there, then that means that's a high probability that the market is going to be able to trade those prices comfortably. So it gives you an idea of volatility expansion. How far can this thing go? And if we take the entire day's profile, that is the max that asset is probably going to go, reasonably speaking, over at least 60% of the days. So there's a high probability. We're looking 60-70% chance that we're going to go to value high or close enough within that price area. So if we already know that, that means that we can set targets that are a little bit out higher than maybe this, for example, right, which will be the C period high, because there'll be liquidity there too. So you can see we started long, and if we measure from our entry to M period, that was a 36 tick move on cable, right? So do the maths, times 10 times 100, right? That's anywhere from, $10 per lot position to $100 per lot position, right? That's anywhere from $360 to $3,600 in the space of 1, 2, 3 hours, right? It depends on how much money you're playing with, right? So I'm not saying this to advertise, like, everyone's going to be a billionaire.
You want to know what I have? A fucking car whose doors open like this. Not like this. Not like this. These are not the doors of a billionaire, Richard.
But this first step was understanding where the liquidity is, understanding that you must react to this. And what's the time? 7 a.m. That's when we got the J period close. Now it doesn't matter if you turned up at 8 o'clock, right? It was at the end of 7 a.m, right? So at 8 a.m, you had a chance to be in. There is no reason for you to wake up at 6 o'clock, right? Because you would have probably been able to trade the J period dynamically. But what if we'd gone up, tested the I period, and then continued lower, right? That means we could take out liquidity under L period. So patience is what I'm trying to say. You want to see us close back above the liquidity. Now, what other information do we have? This is where understanding market profile becomes important, because there's another piece of information we have. And this second piece of information is the L period low is one, and we have the value low from the 126.86. So we can see there was a competitive buyer here. We can see that value low becomes that level where the market is trading a 2-day volatility extreme, right? So there's a good chance we're going to find buyers. In fact, we found some buyers in S period, right? That's what formed the low. And then our next step was to look for liquidity below that low. The same scenario occurred in end period, where we retreated slightly and then we traded under to take out liquidity and close slightly higher. So you're going to find that there are a lot of people who will be buying across the day. But the question you're going to ask me is, oh, well, yeah, that's a good point. But why didn't we trade the end period low? Well, I can tell you exactly why, because it was 8 p.m. in Europe and 6 p.m. in London GMT. Now, I'm not being funny, but you should be having your dinner at 6 in the evening rather than trading the markets, right? Get off of me! Get off of me! Because everyone's got to sign off, right? So this was no time for people to be trading. So it was quite late in the day. Even if you're in the US session, you were still quite late in the day. So no one should be trading at 6 in the evening unless there's something big happening and you're expecting a liquidity grab. You should not be trading at 6 in the evening. Right, so looking at this profile, one, it tells us that we're overextended. Time is not in our favor. So we're better off waiting to the European session to see if we're going to see any liquidity hunts. In fact, by the time we got to 6 a.m., where are we? Yes, no, by the time we get to 3 a.m., sorry, the market had already traded right back down again. So there will be absolutely no reason for you to have traded anywhere around here. Just no reason. You wouldn't even be in the right time. So that brings up another model concept, which is what time is the liquidity? London time? Maybe a little bit in Asia, but it's weekends or low liquidity. So in an asset like cable, it has to be the London European session overlap, or it has to be the New York, Chicago, US session overlaps, right? Those are your only trading opportunities. If you're trading at any other point, you either get an inefficient pricing, or there's just something, you're basically not factoring in the information that is going to come in a high liquidity session. So you're going to be offside very quickly. There's a high chance that you're going to be in an offside position. So how do we combat all of this? It's by taking into consideration everything I'm telling you. Liquidity, liquidity, liquidity. That's all we're interested in. We have no other interest. We don't care about indicators. We don't care about, what Joe Blogg said on Twitter. We don't care about Michael Burry. We don't care about any of the other people that we're compelled to listen to. We don't care about any of that. All we care about is where's the liquidity, right? And that's all we're doing. We're identifying the liquidity. So now that we know that, we've seen that was a cue to be long. Now let's think about what happened next. So we're now trading close to value high. So we have liquidity up at P period, right? We're trading a major US session at this point, which is 3 p.m. Chicago time. We've seen the NASDAQ open, which would have been within this window, Q period. And then we've seen the market go up close enough to value high. So we know there's stops here, and stops here. So these are going to be weak short-term stops, but they're going to open interest. We're going to be interested in these. Right now, if you want to short this, right, when we traded up here and started to pull back in, then this becomes a good short level. Now we have stops under here. So this is another liquidity level. So we have a bit of a problem. The market could go down, trade under, catch liquidity, and rise. S period is also late. It's like 4 p.m. London close. Do you want to be executing into a trade at 4 p.m.? When are you gonna take profit? Well, it has to be tomorrow in the Asian or London session. Well, I'm going to be sleeping in the Asian session, so that means that leaves me the London session. But that's a good portion of time that I'm not awake to monitor my position. So now I'm gonna have to put my stops, right? I'm gonna have to put my stop just above our period. Well, it's not a bad risk reward play, but where's my downside? Well, if I get a liquidity grab just under 127.11, then I'm in trouble. Right now, we do know there's a high probability of us trading back dynamically to 127, which is the value low. So it's not a bad idea, but we don't know if there is a probability we're going to trade under the I period low and take the L period liquidity. We don't know that. So it's pretty risky, this kind of a play. So where would I most want to short if I was going to short? Well, that starts to become common sense. I want to be able to get over at least the E period, or let's say even the J period. I'll start to test the market at the J period, right? But really, I want the E period, right? That's where the strongest liquidity is going to be. Now, whatever happens, I'm going to have an opportunity to trade. So either we're going to take out the I period liquidity, which gives me an almost iron cast guarantee that we're going to walk for the L period liquidity, and the response is going to be pretty damn obvious. Or we're going to go up here and we're going to try and take out the ENT period liquidity, and any response I get from that on the downside, well, I want to get on the short side. Now, what other information does this tell us? It tells us we got a value high here. We got a very weak seller in T period, but we definitely have a responsive seller on R period. So we know there's a lot of money standing here, which means that any inability to break these highs and take the liquidity here is essentially going to see this all coming back down again. So this is the optimal. This is suboptimal, right? Because again, if we divide the high and the low equally, this is a midpoint, guys. This is the fairest value across these 2 days. You're trading the fattest, the mode price, the most traded price. And if it's the most traded price, it means there's so much agreement here that ultimately the price has to move away from this level in either direction. It's just not feasible, which means that you're giving yourself a 50-50% chance that you're right or wrong. That's a coin flip. And again, this is why so many people lose money. Now, I'm not saying this can't retreat lower. In fact, I just said that there's definitely liquidity at the P period high, right? And this would have been a good place to execute for a short position. But what we don't know is, where is this thing going to go relative? We don't know that. So you have to weigh up the risk, right? In the end, you're still going to be able to trade, but what you don't want to do is get caught with your pants down. If you do, then you're going to be regretful. And that's going to influence the way you think about the market. So whilst this is an opportunity, it's definitely not a good enough opportunity like this. It is definitely not a good enough opportunity like that. So where was your opportunity to trade? And that had to come here, and this had to be your exit, right? So the moment we strained in our period, you can see that here, where we strained and we closed just under the liquidity, that was your cue to take profit, right, and get out. The whole day is done. You're literally traded into a US session. There is absolutely nothing more you can do.
Bravo!
Not for today anyway, right? So this is going to force traders to exit the market. So this liquidity becomes the most likely they're going to act on, which means that we will find out tomorrow morning what's going to happen to this market next. There's a good chance that by tomorrow morning, we're going to be down here. There's also a very good chance that we could trade into value low. We bounce off the K period big bull attack and then continue higher, right? Because either way, this could be a consolidation. And why? Because we know there is a liquidity low here. And that's going to present an opportunity for people to buy and gamble on carrying this position into a liquid session, which means by Asia, we may well have reversed all this downside price action. Do you really want to bet on that?
No.
So I don't know what's going to happen. Even though the S period is chucking it, I don't know what's going to happen in the next 20 minutes. Right? It's 4:39. I have no idea. It could keep chucking it, hit a low, rebound. I don't know. But I'm not going to take the risk, right? And that's what you don't want to do. You don't want to get caught in trades where you're shorting at 127.20 and then you close your eyes and you open it and it's 127.34. I know some of you already done that on this day. You've already shorted the R period. It reversed against you. You got out and it's going down and now you're short at 127.20. I know some of you already done that, right? You've already done it and now you're praying that this thing goes down.
Sanka, you dead?
Yeah, man.
Right? So you can get excited. And I guarantee you, the moment it starts to bob, you're going to be taking profits about 127 and saying, oh God, I made 20 pips. I'm so happy. This is the kind of trading you don't want to do. So guys, I hope that you're kind of getting the picture with Market Profile. And I hope you start to understand how we trade it. But to my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?